PantheonAI presents PantheonAI Podcast, April 24th. Welcome back to the PAI Morning Briefing.
Good morning, everyone. It's April 24th, 2025, and we're ready to dive into the markets with you.
Absolutely. Today, we're really looking at this vibrant world of markets and economic trends, trying to give you that panoramic view of where things stand, what's pushing them around, and maybe, just maybe, some thoughtful predictions on what's coming next.
Sounds like a busy day. So where are we starting? Let's get the quick market overview.
All right, kicking things off, our major indexes are actually holding their ground pretty well today. The S&P 500 is sitting at about 5,414.26. That's up about 0.61%.
Okay, modest gains there.
Exactly. The Dow Jones Industrial is also in the green, around 39,614, showing a modest increase, about 0.21%.
And the Nasdaq? That one always seems to have its own story.
The Nasdaq Composite is actually shining a bit brighter today. It's ticked up 1.07%, now sitting around 16,934. Even the Russell 2000 is green, about 1,925 with a slight uptick.
So, U.S. equities looking pretty robust overall then? Average gains across the board.
Yeah, that's the takeaway from the stock side. It suggests investors are gaining some cautious confidence, even with underlying uncertainties still out there.
Right, cautious confidence feels like the theme lately. What about crypto? Is that following suit?
Crypto's a bit of a mixed bag this morning. Bitcoin is trading roughly at $92,870.3, but it's pulled back slightly, almost 0.9%.
Okay, a little dip there.
And Ethereum is down a bit more, about 2.3%, trading near $1,754. It just reminds you how fast and unpredictable that digital asset space can be, doesn't it?
Totally. Like trying to predict the weather in a city known for microclimates. One minute it's sunny, the next. Well, you know. So let's talk about those underlying trends you mentioned. What's really making headlines?
The core theme right now seems to be this balancing act between optimistic growth prospects and the caution driven by macroeconomic factors, especially interest rates.
Ah, the Fed question.
Exactly, and we've seen some strong commentary from Navellier recently. He's been making waves with his really bullish stance on growth stocks.
Oh yeah, Navellier has been vocal.
He has. He's publicly stated, reiterated it multiple times, that he's expecting up to 4 Federal Reserve rate cuts. And he sees that acting as a turbo boost for the market, particularly in tech and innovation sectors, like NVIDIA, which has been at the heart of this tech rally.
That's a pretty optimistic forecast, especially 4 cuts. Has that view been universally accepted?
Not at all. While it's created a buzz among growth investors, some analysts argue that even if the Fed does cut rates, challenges like supply chain constraints, global geopolitical tensions, and inflationary pressures could still spot the market.
So it's not just a straight lineup, even with rate cuts?
Right. This debate is really a central narrative. It's almost like hosting a friendly debate at a dinner party, right? One side is passionately arguing for tremendous upward momentum, and the other is saying, hold on, these structural headwinds are still going to keep things cautious.
Yeah, and if you've been to one of those dinner parties, you know it can be entertaining, but also a little nerve-wracking. Okay, switching gears. What's happening on the corporate front?
American Airlines has been making headlines. They've actually decided to pull their outlook for 2025.
Pulled their outlook? Even after they apparently outperformed quarterly forecasts?
Exactly. They beat expectations on earnings, but management's view on near-term profitability is cautious. For the airline industry, which is still dealing with post-pandemic challenges and volatile fuel costs, that move signals genuine concern over future demand and operational costs.
Wow. So even companies that look good on paper are bracing for headwinds. That's a strong signal.
It really is. Moving along, another story on our radar is about the sectors most vulnerable if mortgage and credit rates keep climbing.
Which sectors are those?
Analysts warn that higher borrowing costs could put downward pressure on the financial, technology, and consumer discretionary sectors.
Okay, so finance because of lending, tech because they need financing, and consumer discretionary because people cut back when money's tighter?
Precisely. Rising rates could slow down home buying, impact growth financing for tech, and dampen discretionary spending. It's like the whole economy is playing a game of Jenga, and pulling or pushing one piece could destabilize the whole thing.
That's a good analogy. Everything's so interconnected. What else are we seeing?
Adding another layer, let's talk about industrials and durable goods orders. Reports recently showed a significant boost in U.S. durable goods orders in March.
That sounds positive on the surface.
It does, but the expert analysis is clear. This strength is unlikely to be sustained. It's being driven by Boeing contracts and companies rushing to stock up ahead of anticipated tariff actions. It's a, quote, front-running mentality.
Trying to get ahead of potential policy changes, so it's not necessarily reflecting genuine sustained demand?
Exactly. Impressive on the surface, but many warn that once this temporary tailwind passes, the underlying demand might not maintain these levels. It's like rushing to fill your pantry before a storm. It looks full now, but it doesn't mean you'll eat that much more long-term.
Another great analogy. So stepping back and looking at all this, what's the common thread you're seeing?
I think the common thread is that the U.S. economy is in this state of both opportunity and caution. Investors are riding optimism from potential easier money policy, but also navigating global trade uncertainties, inflation, tighter credit. It feels a bit like ready, fire, aim mode. Opportunities are being seized, but the risk of overextension is always there.
That's a really interesting way to put it. It does feel like there's a lot of conflicting signals. Let's dive a bit deeper into some of these sectors you mentioned.
Sure. On the technology front, investors are high on hopes for robust growth, but with careful consideration. Growth enthusiasts, like Navellier, are super bullish on tech, expecting rate cuts to open the floodgates for innovation.
NVIDIA being the prime example, right?
Absolutely. But the risk is those high valuations, and the possibility that if the policy shift is delayed, we could see a correction. It's like standing on the edge of a diving board, ready to leap, but you've got to be mindful of how deep the water is.
Good point. What about financials? How are they looking with these rate discussions?
The financial sector sees rising rates as a double-edged sword. On one hand, banks benefit from higher interest margins, which helps their bottom line. That's the good part.
But the flip side?
If borrowing costs get too high, consumers and businesses pull back on new debt. That could stall economic activity and earnings growth. So it's this delicate balance they're watching very closely.
Makes sense. And while not a headline today, we should probably touch on energy, right? It's always a factor.
Definitely. Energy is always fluctuating due to global supply chains, geopolitics, and the shift towards renewables. Even if it's not in these specific stories, investors need to remember that commodity prices and sustainable practice shifts influence overall market sentiment.
Absolutely. And revisiting industrials for a second, that durable goods surge tied to Boeing and tariffs. Are experts really concerned it's just temporary?
Yes, very much so. The concern is that the momentum is driven by preemptive buying, not genuine long-term demand. It's that filling the pantry scenario again. Impressive for a month, but not necessarily reflective of where things are headed sustainably.
Okay, so caution is key there. How do all these U.S. trends ripple out globally?
The reverberations are significant. Global investors are watching U.S. monetary policy, corporate outlooks, and sector trends closely. European and Asian markets are particularly sensitive to signals from the Fed.
So if the Fed cuts rates, that could mean capital flows shift?
Exactly. We could see a rebalancing globally, with emerging markets potentially benefiting from easier financing. But conversely, if global headwinds like trade tensions persist, you might see more cautious behavior internationally, leading to a repricing of risk everywhere.
It's a global dance, for sure. What are the experts saying about navigating all this?
Many veterans anticipate that while there's reason for optimism, a sustained, robust turnaround requires careful navigation. If the Fed cuts, growth sectors, especially tech, could benefit from a liquidity inflection point.
But there are still those external pressures, right?
Right. Persistent trade tensions, inflationary concerns, they could offset the easing monetary policy. One expert recently said the market is dancing a careful waltz right now, and one misstep could temper even the most bullish projections.
A careful waltz. I like that. It really sums up the balance between opportunity and caution. It's kind of ironic, isn't it? Markets can be unpredictable, but they still come back to supply and demand, just with high-frequency trading and digital currencies thrown in.
It is. And as we talk about balance, I have a couple of lighthearted perspectives too. It's not every day you see optimism and trepidation coexisting so vividly. It's almost like watching someone try to ride a unicycle on a tightrope while juggling.
Oh boy.
On one hand, you've got the thrill of the ride, right? On the other, you're desperately hoping none of those balls get dropped. And as an investor, sometimes it feels a bit like you are that juggler, balancing multiple risks while aiming for that sweet spot of reward.
That's certainly relatable. So before we wrap up, let's hit the key takeaways from today's briefing.
Okay. First, our major indexes are showing consistent, if moderate, gains, suggesting broader market resilience despite the mix.
Got it. And then there's that divergence. Tech and growth hoping for Fed cuts, while finance and consumer discretionary might face headwinds from rising borrowing costs.
Exactly. Plus, corporate caution, like American Airlines pulling its outlook, shows that even strong quarterly results don't guarantee confidence in the future.
And that industrial signal from Boeing contracts? Optimistic initially, but caution remains because it might not last through the full cycle.
Right. From a broader perspective, all this makes you think about the delicate balance in modern investing. Will potential Fed cuts lead to a big rally in growth stocks, or will structural challenges hold things back?
And for those in travel and industrials, how will things like American Airlines move and that temporary tariff boost influence long-term strategy? These are the questions keeping investors up.
They really are, and they offer a lot to think about for your next move.
Well, as we bring our conversation to a close, remember that PantheonAI is here as your information co-pilot, helping you navigate these complex market dynamics.
We encourage you, as investors and traders facing these challenges, to take a moment to reflect on your strategies and consider the long-term implications of both macro trends and corporate developments.
So what do you think? Is the optimism around potential Fed cuts enough to offset the market's uncertainties? Could that bullish sentiment in tech really be a watershed moment? And how do uncertainties in airlines and industrials factor into your decisions?
Just some food for thought there. Thank you for tuning in to today's PAI Morning Briefing. We hope this detailed conversation gave you a clear view of the market landscape to help you have a more informed trading day.
Remember to come back for the next episode tomorrow, and you can always reach out to our AI co-pilot with questions. Because, ultimately, learning shouldn't feel like a full-time job.
Exactly. Until next time, invest smartly and stay curious.
PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.